Okay, the next one is business combinations. And to put it into context, this is relevant when you are performing your financial consolidation. Remember, when you perform your financial consolidation, you're bringing assets in at their fair values. And it might differ to the tax cost of the assets and liabilities for tax purposes, giving rise to a temporary difference. So as I mentioned, DTA and DTL, due to financial consolidation, may differ between the economic entity and the entity owning that asset. So that may arise because of the fair value adjustments to those assets and liabilities. Tax consolidation might affect the tax cost of the assets as well. And the standard says, if you have to recognize any additional deferred tax asset and liability, the other side of the entry goes against goodwill. So let's have a look at a simple example. So we have Company A acquiring a target entity, Company B, for $1 million. And in Company B, let's say the assets comprise of stock of 500,000 in the accounts, and that's what the cost is for tax purposes. But Company A says, well, the fair value of the stock is really 400,000, less than what's in Company B's accounts. Company B also has an annual leave provision of 50,000, and naturally Company B will recognize a deferred tax asset on that provision of $15,000. So let's calculate the goodwill. So Company A paid 1 million minus the net asset being the fair value of the stock, add the deferred tax asset minus the provision for annual leave, gives rise to a goodwill of 635,000. Now you note that Company B has a DTA of 15,000 on the annual leave provision. However, at the economic entity level, let's ignore tax consolidation at the moment, the economic entity has two future deductions. One being the annual leave provision, and two being the fact that the fair value of stock is less than the tax cost of 500,000. So there's an additional deferred tax asset of 30,000 on stock. So what does the journal entry look like? This is an initial elimination entry before we apply AASB 112, and this is after. So here we bring in the assets at fair value, 400,000 stock, DTA of 15,000, annual leave liability at 50,000. We eliminate the investment, and we bring in goodwill of 635,000 in the economic entity accounts. However, the economic entity will recognize an additional 30,000 deferred tax asset on the stock. Therefore, its DTA is 45,000, and the other side of the entry will go against a credit to goodwill. Okay. And in your notes to financial statements, you need to show the portion of the change in DTA that is going against goodwill.